What's up, you guys? Welcome back to the Average Joe on Money Financial channel, and on this video we are talking about Vanguard versus Fidelity. More specifically, we are talking Vanguard's VOO S&P 500 ETF compared to Fidelity's ONEQ, the NASDAQ Composite ETF. Both of these ETFs are extremely popular. There's a lot of assets invested in these two exchange-traded funds. So in this video, we're going to break down the differences between these two exchange-traded funds, and hopefully by the end of the video, be able to help you decide which one you would like to own in your own investment portfolio. All right, guys, let's go ahead and get started. I don't want to waste a single moment of your time. You've got busy lives, and we should only spend maybe 5 to 10 minutes here and then move on with your day. We're talking Vanguard's VOO and Fidelity's ONEQ. And the first thing you want to understand is that it's almost like apples to oranges here, because Vanguard's VOO is an S&P 500 index fund, meaning it is based off of the S&P 500 index, or the 500 largest companies here in the United States, based on the overall value of their shares. Whereas the Fidelity ONEQ is based on the NASDAQ Composite Index. Now, the NASDAQ Composite Index is a wholly separate stock market index, totally different place where stocks are traded, and this index actually holds over 2,500 different stocks. Now, there's not that many stocks in this specific ETF, but the point is, we're talking about the S&P 500 versus the NASDAQ index. Now, there's definitely some crossover there in some of the stocks, and you're going to see that when we talk about the underlying portfolio in these ETFs. For starters here, let's talk about the price per share for each of the ETFs. Now, the value of an exchange-traded fund is based on the underlying value of the investments in the ETF. And while the NAV, or the net asset value of the investments in that ETF, is calculated every day at the end of the business day, you can purchase an ETF at any point throughout the day. The share price for ONEQ as of the end of trading this past Friday is $408.13. Whereas for Vanguard's S&P 500 ETF, VOO, the price per share as of July 17th, 2020, $295.55. All right, let's talk expense ratios here. Now, an expense ratio is the cost that Fidelity or Vanguard charges its customers, its investors, to manage the investments in this exchange-traded fund. And you're going to notice a big difference here between Vanguard and Fidelity. Vanguard's expense ratio for VOO is only 0.03%, which means that for every $10,000 invested in this ETF, the fee is only $3 per year. Fidelity's exchange-traded fund ONEQ has a little bit higher of an expense ratio. It's 0.29%, or essentially almost 10 times as high. What that means is for every $10,000 invested in this exchange-traded fund, the annual fee would be approximately $29. Now, both Vanguard's VOO and Fidelity's ONEQ are known as what's capitalization-weighted exchange-traded funds. Now, what this means for the holdings in each of these exchange-traded funds, the underlying investments in the ETF, the capitalization weight means that for each investment, the amount that's invested in each of these investments in the ETF is based on how valuable that company is. Each investment is not created equal. There's not an equal amount of each of these investments in the index fund. Some of the actual stocks in the ETF have a higher value, and thus there are more shares of that specific company in the ETF. As just a quick example, you'll notice if you look at the underlying holdings here for NASDAQ's ONEQ, you can see that a larger amount of the money is invested in Apple or Microsoft or Amazon than there is in Tesla. But that's because these companies, Apple, Microsoft, and Amazon, are much more valuable than Tesla. This means that certain companies might have hundreds of millions of dollars in the ETF invested in that one company, whereas a much smaller company might only have $2 million or $500,000 or maybe even less. Okay, let's look at the overall returns between VOO and ONEQ. The 1-year return for NASDAQ's ONEQ is 26.7%, the 3-year return 18.98%, the 5-year return 16.19%, the 10-year return 18.1%, and the lifetime return since inception in 2003 11.61%. Now for Vanguard's VOO, the S&P 500, the 1-year return 7.51%, the 3-year return 10.69%, 5-year return 10.68%, and the 10-year return 13.52%, which is essentially also the lifetime return because this ETF was created in September of 2010. Now you'll notice there's a significant difference in the returns between Vanguard's VOO and Fidelity's ONEQ. Fidelity's ETF has far outpaced Vanguard's ETF, but remember that they're different indexes that they are tracking. And you should know that the NASDAQ index is much more heavily weighted in information technology stocks. It does have others, but it's very much weighted in information technology. In fact, according to Fidelity's own website, this specific ETF has 41.6% of the investments in information technology, whereas that number is only 27.5% for Vanguard's S&P 500 ETF. And in case you weren't aware, a lot of the market run-up over the past couple of months and over the past couple of years actually has been in growth stocks. And when I say growth stocks, I almost always mean information technology stocks. Companies like Apple and Microsoft and Tesla and Google and Facebook and Netflix, these companies have grown significantly over the past 5 to 10 years. And that's a big reason why the NASDAQ index is outperforming the S&P 500 in this analysis. Furthermore, when you look at the underlying holdings in each of the ETFs, you'll notice a stark contrast in how they are weighted. You'll see here that for Vanguard's S&P 500 ETF, the top 10 holdings in this ETF make up 28% of the overall value of the ETF. In fact, if you look at just the top 3 holdings, we've got Microsoft at 6%, Apple at 5.8%, and Amazon at 4.5%. Just in those 3 companies alone, we've got over 15 to 16% of the overall ETF. Just 3 companies of the 510. It gets even worse though when you look at Fidelity's ONEQ. We already know that they are heavily weighted on information technology companies, but even more so, it's super top heavy when it comes to the top 10 weightings and even the top 3 weightings. As you can see here with Fidelity's ONEQ, the top 10 holdings make up 45.41% over the overall value in this exchange traded fund. But it's even crazier when you look at just the top 3 holdings, because the same top 3 holdings in Fidelity are the same as Vanguard, but the weighting is even higher. You look here, the top 3 holdings are, again, Apple, Microsoft, and Amazon, although you see here that Apple and Microsoft have flip-flopped between first and second place here in overall weighting. Apple's weighting in ONEQ is 10.5%. Microsoft 9.67%, and Amazon 9.27%. Okay, so what you've got going on here is 30% of the assets out of 995 holdings. 30% of the assets, the overall weighting is in 3 different companies. And this adds extra risk to your portfolio. When you buy an exchange traded fund, you're expecting a level of diversification, especially when you see that there's 995 holdings. The S&P 500 is also a little bit top heavy, not quite as bad as Fidelity though. You expect to see some diversification when you buy these ETFs, but the truth of the matter is these top 3 holdings in both ETFs, but definitely more in Fidelity, leave you very exposed to potential downturns in the economy that Apple or Microsoft or Amazon experience. These companies have seemed untouchable though over the past 5 to 10 years. That can definitely change in the future though. Last thing I want to look at here is the dividend yield. Now we already know that both of these companies are very tech heavy, and as a result, tech companies tend to pay less, if any, in dividends because they're much more focused on growth. And that's true here. With the S&P 500 VOO, we've got a dividend yield based on the last 12 months, the trailing 12 months, TTM, 1.81%. And for Fidelity's ONEQ, the dividend yield based on the last 4 quarters or the trailing 12 months is 1.61%. So at the end of the day here, if you're looking to decide between Fidelity's ONEQ and the S&P 500 VOO with Vanguard, you're looking at 2 different entire strategies. Because we know that ONEQ is very tech heavy, you're really just betting on the top tech companies in the United States, whereas with the S&P 500, you do have a much bigger blend between growth stocks, technology for the most part, and value stocks, companies like Procter & Gamble and Visa and Johnson & Johnson and Coca-Cola and Pepsi, which are more value-based. They're already global companies. They're just not growing as fast as other information technology companies that are much more heavily weighted in the NASDAQ Composite Index, or Fidelity's ONEQ. Fidelity's ONEQ has performed much better over the 1, 3, 5, and 10 years than the S&P 500 Index Fund. However, that could change in the future. We've definitely seen information technology take the lead in the growth in this company and in the overall stock market indexes, but that could change because historically value has always outperformed growth over the long term. If you're looking just at returns, you have to go with Fidelity's ONEQ despite their higher expense ratio. That being said, you can also own Vanguard's S&P 500. That's what I own. Full disclosure here, I do not own Fidelity's ONEQ. I own the S&P 500 exchange traded fund in both my Roth IRA with M1 Finance, as well as in my employer-sponsored 401k plan. That being said though, I do have additional exposure to these top companies like Apple, Microsoft, Amazon, Google, Facebook, all these. With the Vanguard Mega Cap Growth ETF, I have a portion of my Roth IRA in this Vanguard Mega Cap Growth ETF. And if you're interested in that ETF, the ticker symbol is M as in Mary, G, K. All right, now is the time to leave your 2 cents in the comments below. Do you own either of these two exchange traded funds? Has this analysis proved valuable to you guys to understand which one you might want to add to your portfolio? Or if you don't own either of them, which one you would look to add to your investment portfolio? Make sure to leave your 2 cents in the comments below. So if you haven't done it yet, and how have you not done it yet? Make sure to hit the subscribe button below and click on that notification bell to be alerted to all of my weekly videos. I put out at least 2 to 3 personal finance videos each and every week designed to help the average Joe out there. People like you and me with all things personal finance, whether it's budgeting, paying off debt, investing for your future, and everything in between. So if that resonates with you, consider hitting that subscribe button and joining the Average Joe on Money financial community. And the great news for you is even though this video, it's about to end, the learning doesn't have to stop. You can click on these videos right over there.